Welcome to Section E on income taxes. The basics are the first definitions, gross income. This is all wages, tips, profits, dividends, capital gains, anything that you may have earned. The adjusted gross income takes your gross income and subtracts the adjustments, such as tax-deferred savings, like a 401k. Exemptions and deductions are subtracted from the adjusted income. These are things like charity contributions, which is tithing. Whatever is left over after you subtract all of this from the adjusted gross income is your taxable income. Your total tax is what you owe after everything is subtracted, like tax credits. Some of the most common tax credits are how much you can subtract per child that you have. And tax refund, this is if you pay more in your taxes with your employer withholdings, then you can get some money back. All right. The first one is tax forms. We're going to find Karen's taxable income. She has $34,200 in wages, $750 in interest that she has earned from her savings account, $1,200 in tax deferred retirement, and a $3,300 exemption, a $5,400 deduction. So we need to first find her gross income. This is everything all added together. So we need to add her wages and her interest. So our gross income will be $34,200 plus $750, which makes her gross income $34,950. The adjusted gross income is where you subtract adjustments like tax deferred savings, and she has $1,200 in tax deferred savings for her retirement. So we take the gross income, $34,950, minus her contributions of $1,200, makes her adjusted gross income $33,750. To find her taxable income, we then go ahead and subtract all of her exemptions and deductions. So we take the $33,750 and subtract $3,300 and $5,400 to get her taxable income of $25,050, and let's highlight that as the answer. Let's move on to Roman numeral 2, filing status. There are 4 different filing status options. Single, this is if you are unmarried, divorced, or legally separated. Married filing jointly is if you are married and filing one tax return, and married filing separately is if you're married and filing 2 separate tax returns. Or head of house. This is if you are unmarried by the end of the year and paying more than half the cost for your supporting dependents. So single parents would fit in that category. Previously, married filing separately or married filing jointly sometimes had a tax benefit. Not anymore. Those are now the same difference. You will not receive a benefit one way or another financially filing jointly or separately. I've had students ask, why would you file separately then? We had a math professor on campus who has been divorced for many years and then got married. So all of her information, her tax forms, were all in her previously single name. Now that she's married, she continued, her and her new husband, to file separately to keep things easier. Let's move on to exemptions and deductions. These are subtracted from the adjusted gross income, and we already talked about it with Karen briefly. An exemption is a fixed amount per person, and this also includes your dependents that you can also subtract. This was decided by the IRS. Deductions, these vary. So if you have a mortgage, charity donations, or taxes paid in another state, or state taxes, these are also subtracted from your adjusted gross income, and you won't be taxed on them again. Standard deductions. These deductions are the most in the salary class that they claimed as deductions. It's decided by the IRS, and it ends up being easier because you don't have to go through all of your records, and it's usually, in most cases I would say, it ends up being a better idea because itemized deductions, sometimes you miss things. Itemized deductions, this is when you go through all of your own records and you add up all of your own personal deductions that you're entitled to. And there are many deductions. That's why they have accountants and even the programs that you can buy on the internet to help you figure out the deductions. In most cases, though, the standard deduction will end up being a better deal. So our first question, A, is should you itemize? Let's say that you have $2,500 in interest on your mortgage, $900 in charity contributions, and $250 in state taxes. This all totals to deductions of $3,650 versus the standard deduction decided by the IRS of $5,150. Which one would you rather subtract from your adjusted gross income to be taxed on? In this case, we'd want to go with the standard deduction because we can subtract an extra $1,500 more that we wouldn't be taxed on. And so I'm going to highlight this as my answer and move on to the next one. Tax rates. The United States has a progressive tax income tax. This means that the higher the income, the higher the tax rate. The marginal tax rates are for the income margins down below. This is the tax brackets for 2011, and they're divided up into different filing statuses. So we have single, married filing jointly, and head of household. You'll notice head of household has some tax breaks. You'll see that they're taxed 10% at a higher money value than a single person who doesn't have dependents. So head of household, remember, this would be like a single adult or a single parent who has dependents and they pay for more than 50% of the needs of their dependents. So single mothers and single fathers have those tax advantages, which we are grateful for. Single over here and married filing jointly. I don't have the married filing separately on this particular file. The next thing that you need are the standard deductions. So people under 65, we have our standard deductions, married filing jointly, single, married filing separately, head of house, and then the additional information and the personal exemption of $3,800. These all change from year to year. As you know, you'll get a new 1040 easy or different things that you have to file for your tax bracket or tax margins and tax brackets. So our first one, we're going to do a tax computation for Brenda. She's single with no dependents with an adjusted gross income of $80,000. We're going to compute her taxes. So the first thing we need to find is her adjusted gross income, and that's subtracting all of her exemptions and deductions. She has $80,000, so we have $80,000, subtract the personal exemption of $3,800, and her deductions, we're going to go ahead and go with the standard deduction for a single person, is $5,950. Subtracting all that leaves us with $70,250 for her taxable income. Now we need to compute her taxes. For this, we need to come back up to our marginal tax brackets and find that she's single. So the first $8,500, she's taxed 10%. From the money beyond $8,500 to $34,500, she's taxed at 15%, and so on. I like to use parentheses to show that at 10% she has the $8,500. Then for the next bracket, 15%, it's $34,500, and then we subtract the $8,500 that she was taxed over here at the 10%. And then the next bracket goes up to $83,600. But she didn't earn that much, or that's not how much is in her taxable income. We only go to $70,250. So I'm not going to subtract 83. I'm going to subtract my $70,000 minus the previous one of $34,500, and that's at the 25% tax bracket. You can copy and paste this into Microsoft Excel or use your calculator and get $13,687.50. I had one student ask why we subtract these. I think some of you who are more analytical would be okay with that. You visual people might like to see this. If you think of all of your money in $1 bills lined up end to end, stretched out across, the first $8,500 for a single person is taxed at 10%. The next bracket, you're taxed at 15%, and we subtract the money over here, and we only tax 15 from 8,500 to the 34,500, and that's the 15%, so that you're not taxed 15% and then again 10% on top of that. Then the next tax bracket, you're taxed 25% with just this money, so we have to subtract the money below it. In this case, 34,500. Let's go ahead with another tax computation of Linda. She's head of house with 2 dependents and adjusted gross income of $80,000. Let's compute her taxes. So we've already adjusted her income, and we need to subtract the exemptions and deductions. Now remember, exemptions are for every person in the household, you and dependents. So she gets a personal exemption of $3,800 for her and her 2 dependents. So it's 3 times 3,800. And then we need to subtract the deduction, and she went with the standard deduction for head of house is $8,700 for the year 2011. And we subtract that deduction, and we now have her taxable income of $59,900. And because she's head of household, we have a different money set up for the margins. So for her, her first 10% comes off of the $12,150. So I do 10% of the first $12,150. Then next is 15%, and this goes up to the $46,250. So I'm going to take my $46,250, subtract what we've already been taxed on in the 10%, which is the $12,150. Now the next tax bracket is 25%. 25% goes up to $119,400, but she didn't make that much. She stopped hers at $59,000. So we're going to go from $59,000 down to the next tax bracket, which was $46,250 at 25%. Plugging all that into your calculator, or what I would do is just copy and paste into Excel. And since I haven't done that in this lecture, I'm going to go ahead and copy it in. Go into Microsoft Excel, press equals, Control V, and I see that I didn't copy that last set of parentheses. And you'll notice my order of operations say I want to calculate this multiplication, then add whatever comes in this calculation, and I need my subtraction within these parentheses so that I subtract and get that money, which is the 15% tax bracket, and so forth. And I also know that Microsoft Excel will not recognize commas, so I'm going to delete that, press enter, there we go. And I can go ahead and format that cell to be currency, and then I can copy and paste it right back into here, $9,742.50. Let's go to the next one, married filing jointly with no dependents. Diana and Greg are married, they have no dependents, and they're filing jointly, with each having an $8,000 adjusted gross income. So let's compute their taxes. The first thing we want to do is add up their income of $80,000 plus $80,000 gives us $160,000. They each get a standard exemption, and since there's 2 of them, we do 2 times the 3,800 that we got from our file up here, 3,800. And then we're going to use the standard deduction. Married filing jointly is $11,900. So we subtract that and we get their taxable income, and I'm going to highlight that, of $140,500. And then I'm going to go up and have to find my tax bracket for each of their margins. So I have 10% for the first married filing jointly, 17,000. The next one goes up to 69,000 and I subtract the 17,000 that we were previously taxed the 10% on. So 69,000 minus 17,000. And I put these within their own parentheses. So I subtract first and then multiply. And then I need to find the 25% tax bracket. 25% goes up to $139,350. So $139,350. Subtract the previous bracket of 69,000. That's the 25% tax bracket. Now I go just a little bit over into the next bracket. This was $139,350. They barely went over, so I'm not even going to go up and look at the next bracket because I know that I'm not very far into it. It's $140,500. Subtract the previous bracket of $139,350, and this is the 28% tax bracket. I can copy and paste into Microsoft Excel, calculate it for me. Copy. Just choose any cell and make sure I have all, oh, I didn't copy that last parenthesis. I don't have any commas, so I can press enter. There we go, $24,409.50. This would be the exact same if they had filed separately. I'm going to assume that they have all of their paperwork together and with the same last name. All right. Remember that when you fill out your W-4, this is when you are employed. It has money taken out of your pay. And if you have extra money taken out of your pay, then you need to pay for your taxes, then you'll end up getting a refund. If you don't pay enough, then you have to pay taxes. The W-2 is what your employer sends to you at the end of the year so that you can calculate your taxes. Let's move on to Roman numeral 5, tax credits and tax deductions. A tax credit reduces the total tax bill, and they are much more valuable. The tax deduction reduces your taxable income, so you only get a percent off because it reduces only how much is in up here in this category. So you'll be reduced if it goes down by a little bit in here, you'll reduce your taxable income by 25% of that. So you only get a portion of it. Okay, let's go ahead and do a calculation. Suppose that you are in the 28% tax bracket. Let's compare what a $1,000 tax credit versus a $1,000 tax deduction would do to your tax bill. Let's go ahead and use Diana and Greg. They were in the 28% tax bracket barely, and they owed $27,409. If they had a tax credit of $1,000, it saves them the full $1,000, and they then owe $26,409. So it was worth $1,000 to them. Being in the 28% tax bracket, at best, it would save them 28% of the $1,000 because it only subtracts it from their adjusted gross income. So 28% of that $1,000, at best, it would only be saving them $280 that they might have been taxed on previously. And that's only if you're itemizing. If you're using a standard deduction, then the $1,000 deduction does nothing to you at all because you're not itemizing your things, you're just taking the standard, whatever the IRS took. There's also another option that $1,000 might not put you all the way into the next tax bracket, and so you might be in the 28% with that 1,000, and then it moves you down into the next tax bracket, and so you're only getting a little bit of both. So that's the best option if you are very much into the 28% tax bracket. Let's move to the next example. Rent or own. Suppose that you're in the 28% tax bracket and you have the option of renting for $1,400, or you could have a mortgage payment of $1,600. with an average of $1,400 of that going towards your mortgage interest, which is tax deductible. So the government would like you to go ahead and get a mortgage so that you can pay interest and keep the economy going. But it is actually to your advantage. Let's go ahead and look at it. If you are in the 28% tax bracket and the $1,400 is going to your tax deduction, then 28% times that mortgage, the interest on your mortgage, is $392. So even though the mortgage is higher, you get a little bit of a tax break because of being in the 28% tax bracket. And it saves you $392. So really, your rent is only costing $1,208. So it's actually cheaper than renting in the first years. Because as we talked about previously, once you pay down your interest, more of your money is going towards the principal, and so you're not getting as much of a tax break because you don't have as much on interest, which is nicer because if you end up selling it, you get money back and it builds your equity. Plus, then you have all of those other values of ownership. Let's move on to the value of a deduction. Let's compare Drew and Marion. Drew's in the 15% tax bracket and Marion's in the 35% tax bracket. Each of them itemize and the deductions of a donated $5,000 to charity. Now, the reason we say it's itemized and that they aren't taking the standard deduction is that if they took the standard, then it's not going to, it possibly won't do anything to their deductions at all. So we're going to say they're itemizing, and by the way, tithing is tax deductible, which is why at the end of the year you have tax or tithing settlement so that you can make sure that the bishop can give you your paperwork for your taxes. Same as getting a W-2 from your employer. Let's go ahead and find the true cost of each donation. So Drew is in the 15% tax bracket and he donates $5,000. So that is 15% of the $5,000. He saves $750 because he's not being taxed on that $5,000, which would be $750 towards his taxes. So his true donation, because he ends up saving some money, is really only $4,250, not the full $5,000, because it saves him paying $750 in taxes. Marion is in the 35% tax bracket, so she saves $5,000 times her 35%. She ends up saving $1,750 that she doesn't have to pay in her taxes. So her donation, I subtract my $1,750. She really is donating $3,250. That's the true cost of what is coming out of her paycheck because she would have had to pay the $1,750 anyway to taxes. So her true cost of donation is $3,250. Let's go to number 6. Social Security and Medicare. FICA stands for Federal Insurance Contribution Act. This is where the government collects money for Social Security, Medicare, and just primarily people who are retired. You have a 7.56% being paid towards all wages of $94,200. An additional 1.45% comes off of wages over $94,200. Employers must match FICA payments for every employee. So that means if you're self-employed, you must pay double. Once is the employer and once again is the employee. Let's go ahead and go to our first example of Jude. Jude is single with no dependents and earned $22,000 in wages. Now remember, FICA only comes off of wages. What will FICA withhold from her paycheck? And what will her overall tax payments be? And what will her overall tax rate be? So we have 3 questions here. The first one is, how much will FICA withhold from her paychecks? So she earned $22,000. That is underneath the $94,200 for the percentage here. So it's change that to a decimal, 0.07565 times 22,000 gives us $1,683 that FICA withholds from her paychecks. Now we need to find her taxable income. We take her gross income, and we subtract any adjusted payment. They didn't give us any deductions for that we need to subtract for a tax deferred or 401k. So we're just going to subtract our standard exemption and deduction, which we found up here previously. Exemption of $3,800. She was single, so the deduction, the standard deduction, is $5,950. So she has a taxable income of $12,250. Now we need to find her overall tax payments. I remember from a previous example that it's 10% for the first $8,500. It goes up to, I believe, $34,500, but Jude didn't have that much in her taxable income. Her taxable income is $12,250. So I'm going to take the $12,250 and subtract what was taxed over in the 10%, which is $8,500, and multiply that by the 15% tax bracket. Copying and pasting that into Excel will give us $1,412.50. This right there is her overall her taxes from the tax brackets. We want now her overall tax payments. So we're going to take FICA and her taxes, adding those together, $1,683, add to the $1,412, gives us her total tax of $3,095.50. Now the last question is, what is her overall tax rate? So if I have all of the money she paid in taxes divided by all of the money she earned, I take $3,095 divided by she earned $22,000, gives us 0.14, or 14.1% is her overall tax rate. Let's move to dividends and capital gains. A capital gain is the profit from the sale of a stock. A short-term capital gain are profits on items sold within 12 months, and a long-term capital gain are profits on items sold after 12 months. It has now changed as of the year 2011, but I know for the year 2013, you are taxed nothing on capital gains that end up being in the 10 to 15% tax brackets in the IRS charts. And you're charged 15% on any of the rest of the money that you earn on capital gains above the 15% tax bracket. To find that, we scroll up to our tax bracket, 15% single, married, and head of house. If you earn more than this, you are then taxed at 15% on your capital gains. So let's take our first example of Serena. She is single and living on her inheritance. Her gross income is $90,000 and it's solely on dividends and capital gains. She doesn't have any wages. So there are no adjustments. She doesn't have any tax deferred savings, but she has $12,000 on itemized deductions. What tax does she owe, and what is her overall tax rate? So we take her $90,000, we subtract her deductions, and of course her personal exemption of $3,800, making her taxable income $74,200. For the first 10 to 15%, so she's single, and that gets us up to $34,500. Just to double check, we'll come up here single. The 15% ends at $34,500, so she owes nothing on those wages or profits from her capital gains up to the $34,500. Previously, it used to be 5%. and things have changed. It's now 15% for the rest of the brackets above 15%. So the rest of her money, starting at $74,200 from her taxable income, and we subtract the $34,500, she's taxed 15%, which gives us $3,970. To find how much her overall tax rate is, we take all of her taxes, which in this case, she doesn't have any FICA, so we don't have to add that in. She doesn't have wages, so it's $3,970 divided by her overall gross income of $90,000. So her taxes over her gross income gives us, 0.0441, or in our case, 0.44%. Let's move on to tax deferred income. This is when you're taxed on money that you draw out, such as retirement, like a 401k. So if let's say this person is single with a $65,000 taxable income, and they're making monthly payments of $500 into a tax-deferred retirement plan. How much do the tax-deferred contributions affect this person or your monthly take-home pay? If this person's single at $65,000, that puts them in the single 65, that's in the 25% tax bracket. So come back down here. On your test, you'll have that tax bracket in your in your test sheet that you don't have to keep flipping back to. You could even print it off and have it right next to you. So that's 25% that you're saving of the $500 every month. So 25% that you're not going to be paying in the taxes of that $500 saves you $125 every month that you would have had to pay taxes on. So your monthly paycheck goes down by $500, but really you don't have to pay that extra $125 in taxes, and it's affecting your monthly pay by $375 because you didn't have to pay that $125 in taxes. I hope you join me for our next section. We're moving into a new unit. Enjoy and good luck on your test.